Hello and welcome to another session of the My Solo 401k Financial My Community daily webinar series. Thank you so much for taking the time to join. We're excited to discuss these great topics. Specifically today, we're here to discuss Mega Backdoor Roth. Should you transfer to a Roth Solo 401k or a Roth IRA? So we go live twice per day, once at 10 a.m. Pacific, 1 p.m. Eastern. Then we're back again at 1 p.m. Pacific, 4 p.m. Eastern. This is our afternoon session. So you can always subscribe on our YouTube channel and hit the notifications bell. Then you'll get the notifications. You can join live, ask questions, hear what other people are asking. Another great venue is going to be our community. We have over 30,000 members in our community. It's a vibrant community. We have forums. We have a library of videos and webinars. So there's a lot of great ways to learn and to share the knowledge. Now, with that stated, let's get into the topic. Again, if you have questions or topics you want to chat over, please don't hesitate to do that, as we'll have time after we go through this topic to go over your questions. It can be about a different topic. It doesn't have to be about this topic specifically, but we definitely want to talk about, should you transfer to a Roth Solo 401k or Roth IRA? As that's a very common question, especially for those that are making mega backdoor Roth contributions, which is one of the top reasons that customers sign up with us. So as always, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So just going to verify the audio here. Make sure we got our best audio possible. 1 second. All right. So again, if you have some questions or topics you want to chat over, please don't hesitate to do that now. But we're going to go through these slides. Okay. So another reason to subscribe to the channel is you get notifications. For example, we go live twice a day. We usually bring content. And for example, on Fridays, we typically have deeper dive content. So tomorrow, we're going to be discussing in the morning session at 10 a.m. Pacific, 1 p.m. Eastern, a $70,000 Roth IRA strategy. How to use Mega Backdoor Roth Solo 401k to save $70,000 in a Roth IRA. Then in the afternoon, we'll be back at 1 p.m. Pacific, 4 p.m. Eastern to discuss 2025 Solo 401k magic number. How much W-2 wages needed to max out Solo 401k contributions? These are great topics. So please subscribe, then you get the notifications. You can join live or just come back later and watch the recording. So it's always good to lay the foundation, I would say, with eligibility. So a Solo 401k is an owner-only plan. So it's a plan for a self-employed individual. So to be eligible, you have to be self-employed and have no full-time W-2 employees working for any business owned by you or a spouse, if any. So think like an independent contractor, a solo practicing professional, like a CPA or realtor, could be a medical professional. And the key, again, is not having any non-owner, non-spouse, full-time W-2 employees. Some of the top eligibility considerations would include, do I need a separate entity like an LLC or an S-Corp? And the answer is no. We have many customers who operate as sole proprietors without a formal legal entity. Ultimately, the key is that you report earned self-employment income in your taxes. Now, that could come in different forms. For example, for a business that's taxed as a sole proprietorship, that would be income reported on Schedule C. But for a business taxed as an S-Corp, that would be W-2 wages. There's no minimum amount of earned self-employment income that one needs to be eligible to set up a solo 401k. One spouse or business partner may participate as long as one spouse or business partner are also reporting their own earned self-employment income, such as their own Schedule C or their own W-2. It's possible to set up a solo 401k even if you have a W-2 day job, even if you participate in your W-2 employer-sponsored plan, as long as you've got that separate earned self-employment income with no full-time, non-owner, non-spouse W-2 employees. Now, one of the top reasons the customers set up an account with us is because our plan allows them to make mega backdoor Roth Solo 401k contributions. So when you make a mega backdoor Roth Solo 401k contribution, the individual is really going to be able to maximize the amount of funds that end up in a Roth account. And like any Roth account, that's where you have the potential for tax-free growth. So for example, for 2024, the limit is $69,000 or $76,500 if you're age 50 or older. For 2025, it goes up to $70,000 or $77,500 if you're age 50 or older, or $81,250 if you're age 60 to 63. Now, the key is that you need to find a provider. So you not only have, of course, have to be eligible to set up a solo 401k, you've got to find a solo 401k that supports the mega backdoor Roth. So that's not going to include your basic plans at discount brokerages. For example, Fidelity offers a solo 401k, but it's a basic plan, doesn't allow for Roth. Schwab's plan doesn't allow for the mega backdoor Roth. So you need to find a provider like us that offers a plan that allows for voluntary after-tax contributions and then in-service distributions, because the funds are either being transferred to a Roth solo 401k or Roth IRA. We're going to turn in a moment to those top considerations. And of course, you're going to want to not only find a provider that allows you to make those mega backdoor Roth contributions, but also has experience, because it is a specific compliance process that has to be followed. For example, it's going to be a two-step process. So you'd want to look for a provider that's going to assist with establishing the required sub-accounts, because first step is the money goes into an after-tax account before it moves over to a Roth account. Again, either a Roth solo 401k or Roth IRA. And even though that first step, the contribution is not reportable on the personal or business tax return, the second step, when you move the money over to the Roth account, that is reportable on a Form 1099-R. And we handle the 1099-R as an optional free service. In other words, no additional charge for our customers. So we got a couple of visuals to show how the account structure would look. So if you have a one participant plan, they're going to have three different accounts, right? Pre-tax, Roth, and after-tax. If it's a two participant account, there's six accounts, right? Pre-tax, Roth, and after-tax for each. And then if they're moving the money out of the plan to a Roth IRA, they might just have one account or two accounts inside the solo 401k, right? Two if they're going to have pre-tax and after-tax funds, or maybe just an after-tax solo 401k account if they're only going to make after-tax contributions and then transfer those funds out of the plan to a Roth IRA. So now let's turn to the good question of, should you transfer after-tax solo 401k funds to a Roth solo 401k or Roth IRA? Well, it's going to depend on the person's objectives and situation. So for example, many of our customers want to transfer to a Roth IRA. And oftentimes that's because they might be satisfied with the performance of a particular Roth IRA. So you could transfer those voluntary after-tax solo 401k funds out of the solo 401k plan to an existing Roth IRA. So they might want to further deposit money into that Roth IRA to further grow that account. That's totally fine. So that would be a good use case, right? You want to maximize money going into a Roth IRA where you're satisfied with that performance, right? Now, on the flip side, some customers want to keep the money in the solo 401k plan. And why is that? Well, they might want to take a loan or think that they might want to take a loan from the plan in the future. So you cannot take a loan from any type of IRA, including a Roth IRA. But you can take a loan from a 401k plan as long as it's a plan like ours that allows for 401k loans. So a loan is where the individual is literally borrowing money from the plan, withdrawing money from the plan. They can use the proceeds of that loan for any purpose whatsoever. It's not going to be considered a taxable event. It's not going to be subject to penalties as long as it's, number one, documented as a loan, which we handle the loan documentation requirements as part of our service for no additional charge, and then paid back according to the loan terms. So the loan terms are going to require that the loan is limited to 50% of the balance, not to exceed $50,000, needs to be paid back in either monthly or quarterly payments, equal payments of principal and interest. The interest is either prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. So that would be a good reason to keep those funds in the Roth solo 401k. Another reason would be the ability to invest in alternative investments. So with our plan, it not only allows for making mega backdoor Roth contributions, but also allows for true alternative investments, right? This could include real estate, crypto, private placements, private stock, precious metals, etc. So that individual will have direct checkbook control over their Roth Solo 401k account, which will allow them to access the funds quickly to take advantage of an investment opportunity. Whereas if they were to transfer those funds out of the Solo 401k to a Roth IRA, first of all, that Roth IRA that they transfer the funds to may not allow for those alternative investments. But even if it does, if it goes to a truly self-directed Roth IRA, the IRA rules are different, where the funds need to be at a specialty trust or third-party custodian that's going to have access to those funds. So they're not going to be able to have that checkbook control over those Roth IRA funds unless they go to the trouble of investing the Roth IRA funds into an LLC. So just keeping the money in the Roth Solo 401k will allow the Solo 401k participant to have that direct checkbook control, will allow them to invest in alternative investments much more easily compared to a Roth IRA. And then within that subset of folks that want to invest in, say, real estate, another advantage of the Solo 401k versus the Roth IRA is the fact that if one invests Roth IRA funds in debt financed investments, right? Let's say they want to use their money to invest in real estate and they want to combine their Roth IRA funds together with debt. It needs to be a special kind of debt called non-recourse financing. The issue, though, is that income from debt financed real estate investments inside a Roth IRA will be subject to a special tax, generally speaking, which is unrelated debt finance income tax, which will, of course, reduce the return in that investment. Whereas if someone were to make that same type of investment inside of a Roth Solo 401k, right, using their Roth Solo 401k funds together with that non-recourse financing, there's an exception to that UDFI tax for income from debt finance real estate investments inside of a Solo 401k. So for that subset of investors, keeping the money in a Roth Solo 401k will present a tremendous advantage relative to transferring the funds out of the after-tax Solo 401k to a Roth IRA. From an RMD perspective, the two types of account have equalized because now, since 2024, RMDs do not apply to a Roth Solo 401k. In terms of the distribution rules, a Roth IRA is more permissive because you can withdraw your basis from a Roth IRA at any time, whereas you would need to meet a triggering event before you could withdraw money from a Roth Solo 401k, other than, of course, the loan scenario that we already discussed. So you would need a triggering event to otherwise withdraw money from the Roth Solo 401k, such as being aged 59 and a half. So it's going to be more restrictive in terms of those early withdrawals. And then even if one does take an early withdrawal from a Roth Solo 401k, you have to take a proportionate amount of the basis and the gains. So you would end up having to pay tax on the gains portion. But those are your top considerations in terms of whether or not one should transfer after-tax Solo 401k funds to a Roth Solo 401k or Roth IRA. Now, I want to go to one of the good questions. Thank you so much for bringing the question. We appreciate it. And then we'll come back to talking about the deadline. So if in the Solo 401k, the employer makes a voluntary after-tax contribution, should this immediately be converted to Roth as cash, or should it be invested in the after-tax account prior to the Roth conversion? Well, most folks will immediately or shortly thereafter move the money over to the Roth account. And the reason for that is that there are gains inside that after-tax account. Those gains will ultimately be taxable. Whereas if the money is first transferred to the Roth account and then the person invests the money inside that Roth account and there are gains, those gains will grow on a tax-deferred basis and potentially be tax-free. They would be tax-free if at the time of the withdrawal, the person is able to make a qualified Roth distribution. For example, they've had that Roth Solo 401k account for at least 5 years, and they're at least 59 and a half years of age. Thank you so much for the good question. And so if you're finding this to be helpful and you're on YouTube, please subscribe, please like the videos. It helps us to get the word out. We do appreciate it. Thank you so much for the great participation. We really appreciate the chance to discuss these topics. So I wanted to turn to the deadline to make contributions, just because it's a common topic this time of year. So for those individuals who signed up with us before the end of last year, or if they had set up a plan somewhere else, right? Let's say they set up a basic plan at Fidelity or Schwab, and then they wanted to upgrade it to our plan here to take advantage of the service and features of our plan, like the ability to make mega backdoor Roth contributions. For those individuals that had established a plan before the end of last year, they would have preserved the ability to make all types of contributions, whether employee, employer, or voluntary after tax, by their business tax return deadline, including extension here in 2025. But for those who had not set up a plan before the end of last year, whether it was somebody else or signed up with us until 2025, it's still possible to make 2024 contributions, but it's more limited. So the type of contributions that you can make and the deadline that you have to make those contributions by will depend on how your business is taxed. So for a business that's taxed as a sole proprietor, it's still possible to set up a plan here in 2025 and make all types of contributions for 2024, including employee, employer, and voluntary after tax. Now, those employee contributions for 2024 for a business taxed as a sole proprietor, the person would have to sign up in time to make those employee contributions for 2024 by April 15th. Otherwise, if they file a timely extension for their business tax return, in other words, their 1040, they could still make employer and or voluntary after-tax contributions for 2024 by their business tax return deadline, including extension, i.e. October 15th, in the case of a business that's taxed as a sole proprietorship, where the individual filed an extension for their 1040. Now, for other business types, right, partnership, S Corp, C Corp, if you hadn't set up a plan, either with us or somewhere else before the end of last year, in other words, you didn't sign up with us before the end of last year, and your business is not taxed as a sole proprietorship, it's too late to make employee contributions for 2024, but there's still time to make employer contributions, as long as the plan is set up in time to make either those employer and or voluntary after-tax contributions for 2024 by your business tax return deadline, including extension. So for a business taxed as an S Corp, let's say you filed an extension for your 1120S for 2024. That individual could still set up a plan for 2024 and make either employer and or voluntary after-tax contributions for 2024, as long as they sign up in time to make those contributions by the extended business tax return deadline. In other words, September 15th in the case of a extension for an 1120S. Well, wonderful. We again appreciate all the engagement. Please like the video. Please subscribe if you found it to be helpful. That'll also get you the notifications of when we go live. We go live twice per day. Again, we'll be back again tomorrow, back in the morning at 10 a.m. Pacific, 1 p.m. Eastern, to discuss $70,000 Roth IRA strategy, how to use mega backdoor Roth solo 401k to save $70,000 in a Roth IRA. In the afternoon, we'll be back at 1 p.m. Pacific, 4 p.m. Eastern, to discuss the 2025 solo 401k magic number, how much W-2 wages needed to max out solo 401k contributions. Okay, great. We got another question here. So thank you so much for bringing the question. I made an after-tax contribution by check in December 2024. The contribution wasn't available for investing as cash until January 2025. Should I get a 1099-R for 2024 or 2025? So that's a common question. You certainly met the deadline, right? Because the deadline is not until the business tax return deadline, including extension. And really the deadline applies to making the contribution, right? There's no deadline to move the money from the after-tax account to the Roth account. And there's plenty of individuals who are not moving the money until 2025 because they didn't even contribute the money into the after-tax account until 2025. So what date or what year the 1099 will be issued for will depend on when the money was moved. So if it was moved in 2025, it'll be a 2025 1099-R. And then for our customers, they just need to submit the online form on our website, mysolo401k.net/forms, to access the forms. That's how we collect the information we need to prepare the 1099-R. And we do that as an optional free service. In other words, no additional charge as long as customers let us know about it in a timely fashion. Great question. Thank you so much for bringing it. All right, well, thanks again, everyone. Appreciate the great participation. Thanks for checking out today's video. Please continue to participate, whether here on the YouTube channel, just by subscribing, or on the community, in our forums. So making the contribution is not reportable by the business or on the personal tax return. It's not reportable by the plan. What's reportable is when you move the money from the after-tax account to that Roth account. All right. Well, thanks again, everyone. Until next time, appreciate it.